Investing for beginners, high yield bonds. We're going to talk about high yield bonds today in response to a comment I got in one of my videos about a gentleman, I think it's a guy, who was saying he was thinking about doing high yield bonds in his Roth IRA. What did I think about that? It's actually a pretty good springboard. I want to do a couple tutorials on investments for beginners, and this is a good springboard to that. So you out there, I don't know your name, but I certainly appreciate your comment. And folks, comments are welcome across the board. We had a couple guys being mean, and I'll delete those. But if you have questions or comments, I'd love to hear them because they actually help me tighten up in terms of my own financial planning and the way I explain things too. So put a comment down below if you have one for sure. Just don't be mean. Don't say stuff about people you don't know. That's weird. But anyway, and don't forget to subscribe there. Subscribe. You see that little button down there too. So thanks for coming to the Heritage Wealth Planning YouTube channel. Let's jump right into this. This is actually an interesting one because you had about high yield bond funds. And I want to start with I always start with Yahoo is where I always go to first and foremost. I don't know why. I used to use CBS Market Watch and now it's become Market Watch. And I don't use those anymore. I don't know why, but Yahoo Finance has always kind of been my go-to place. And the first thing I want to share with you what a high yield bond is. High yield just is synonymous with junk. All right. And that doesn't mean they're all going bankrupt. It just means they're below credit grade quality. I forgot what is triple B, or I can't remember what the ratings are, but it just says junk bonds below credit grade quality. I think that's triple B. Is that the beginning? Below investment grade quality. I think triple B and above is investment grade. I can't remember. But anyway, just remember, junk bond is synonymous with high yield, which means it's below investment grade quality. And what we'll see here is this is the Vanguard one, has a yield of 5.36. All right, so that's what's paying right now. Generally, well, let's see, the 10-year treasury right now is paying about 2.8. Let's see, the 10-year treasury is paying 2.89. And so as you can see here, that's a little bit less than double the 10-year treasury, which is the risk-free asset. And a corporate bond is probably paying 3.5 or something like that. So maybe 4. So the reason why high yield bonds are yielding high yield is because they're more risky. No getting around that. Don't let this chart frighten you there. That's just day to day. So let's just look at this chart real quick. And you can see right there, that's the decline in 2007 to 2009. Vanguard's actually was not nearly as brutal as other funds were, but it was still down. We'll show you here in just a second. So a high yield bond fund is going to have a bunch of low credit quality bonds. In Vanguard's case, it has almost 500 holdings in it. So any one bond isn't going to make or break it. It just means there's more of a likelihood for those bonds to go kaput. All right. But I do want to show you here real quick. This is I got to go up here. Performance right there. Actually, does it tell us what the inception date 1978? It doesn't tell us what it's done year over year. Since inception. So I'm going to show you something because this is important right here when it comes to high yield bond funds or any bond fund in particularly is the year over year. And I want to show you this. Best 1 year return. No, that's not right. 2018 now, so they don't have that right. Yahoo, come on, man. Number up here is 34. Number down here is 5. 5-year average is 4.82. Don't really care. But so I want to go back. This is since 1979 is when this guy was started. And look, we'll just start going here. Look, we have 27% return in 1982, 16% in 1983, 22%, 16%, 13%. You see and see. Now what happens is we have a down year in 1990, a couple up years in 91, 92, 93, a down year, and then we go to 2008, and that was when, again, this bond fund was lost basically a quarter of its value in about a 16-month time frame. Now, it gained it back up in 2009. But the point of this is what I want to show you. Look at these returns here now. A lot lower than they were down here. All right. And the reason for that, and this is for any bond fund, my friends, you just simply can't look at your total return going back to inception because these years are gone. The 80s, late 70s, early 80s, those days are gone from bond funds. Look, in 1982, do you know what you could have got on a 30-year treasury at that point? You could have bought a 30-year long-term government bond, what's called a long bond, is paying 15 and a quarter. That means you'd have got 15.25% every single year guaranteed by the feds until the end of 2011. You put $100,000 in that puppy, you are getting 15,000. Let me close out this. $15,000 of interest each and every year guaranteed by the feds. Now, you're thinking, well, that's great. I'd totally have done that. Would you have? The answer is you would not have. And why? Is because short-term money was actually paying more. And the reason for that was because inflation was rearing its ugly head here in the States from Nixon through Carter until Reagan, and then Paul Volcker and Ronald Reagan got together and they absolutely whipped inflation now, which I think was one of Nixon's campaign slogans, which he never did. In fact, he hurt us when it came to that. So inflation was rearing its ugly head in 1982. Nobody knew that inflation was going to be whipped because of Paul Volcker raising the interest rates back then with a blessing of Reagan, which cost Reagan his Senate majority, by the way, in the midterm elections in 1982. It did, in terms of political, it hurt Reagan. In terms of economic growth, though, this was the beginning of a new era of U.S. dominance in the economic world. There's no getting around that, because they were able to get inflation under control. But very, very few people were buying 30-year bonds because they were so worried about inflation eating away at the purchasing power. They did not want to lock up their money for 30 years. And we can see what's going on when inflation kicks in. Just look at Venezuela. You can look at Zimbabwe. You can look at Cuba. Inflation is always a monetary issue where it can really, really do devastation big time. And no one wants to lock up their money for 30 years when they're worried about 6 months from now what the price of goods are going to be. And a true inflationary issue, and this is not, I mean, we weren't in Venezuela or Zimbabwean, but I mean, my goodness, the price of a loaf of bread today might be $1. 6 months from now, $1 might only buy you a slice of bread. That is how inflation works. And so no one is going to lock up $100,000 if they think that they can't buy a slice of bread for that $100,000 in 30 years' time. And so anyway, I just want to point that out because a lot of people think these returns, I might be able to get 22%. No, you're not going to. But they'll say right here, but Josh, look, I got 39% that year. You did, because this was, again, an anomaly because of mark-to-market accounting. And that meant the liquidity, the markets for liquidity of bonds was completely blown up because of mark-to-market accounting. Now, Barney Frank, to his credit, and I don't agree with Barney Frank on hardly anything, but he was a pragmatist. I wish we had more politicians like that who are pragmatists. And Barney Frank says, the mark-to-market accounting rules are hurting liquidity in the economy. We're going to get rid of them. And they did that on March 9th, 2009, March 10th. They actually had a congressional meeting on that on March 10th. And that was the end of the bear market from October 2007 to 2009 because of getting rid of mark-to-market. So all the liquidity that was dried up here all of a sudden flooded back into the market, and we just made even. So that was what happened there. So why am I pointing at this? Because look at that. That looks like a stock chart, doesn't it? Down 21%, up 39%. But yet, look at this: 7% in the last year, 11 down a 0.44, 14.7. So I want to show you something. I'm going to take you to the Vanguard. So this is the most important screen you'll ever see, my friends, because Vanguard will show you. And again, we're using the Vanguard High Yield Fund. Where the returns come from. Do they come from capital returns or they come from income returns? And if there's anything I can get you to understand when it comes to bond funds, there is no capital returns. Capital returns means price appreciation. There is none. Bond funds do not appreciate in price. They just don't. And I'll share with you exactly why. It's mathematically impossible for that to happen here in just a second. But remember, bonds, they give you yield. They don't give you appreciation, yield or interest, if you will. That's what they get. So right now, the Vanguard bond fund is paying about 5.5. That's roughly what it's paying right now. All right. So the income return, that's the yield. The interest you're getting, 5.5. The last 2 years ago is 5.92. 2015 is 5.32. 2004. So you can see all that. All right. But their total return, wow, we're only getting 5.42, but we actually got 7.02 total, and we got 11.19 in 2016. So, Josh, you're full of crap. You're saying there is no capital return, but if I'm only getting 5.5 on the yield, I'm getting 7%. I'm getting a capital return. I'm getting that return from someplace. Yep, you are. It's 1.54 for that year, 5.27 for the previous year. But look at this. I got 5.32% as my yield, but I had a negative return. Why? Because I had negative 6.72% on the capital return. How a bond works, bond 101. You buy a bond for $1,000. We'll just say it's $1,000. Every year it pays you, we'll say 5% for simplicity. 5% what's called a coupon. So I'm getting a 5% coupon on $1,000. That means I'm getting $50 a year. $50 a year is always happening. Nothing changes. I'm always getting $50 a year in, year out, year in, year out. I get $50 a year. Now, what happens is, as long as this company doesn't go bankrupt or government, I will get that $50. And then when the bond matures in 20 years, I get my $100 back. It's that simple. This goes flat. My price per share is always 100, or at least my maturity value is always 100. And in the interim, I'm getting that 5% a year. That's how it works. If there's any price per share, it's not a appreciation. It's just an interest rates have dropped across the board. So that bond right now that's paying 5% looks more valuable to investors today, but that will be given up as the bond matures. It's science, it's math. I don't even know how else you could describe it. A bond is issued at 1,000, it matures at 1,000. It could have different price per share throughout the time from issue to maturity date. It could go to 980 to 120, but at the end of the day, the $100 or $1,000 bond will be returned to you at $1,000, and you'll still get that 5% a year. That's it. So any price appreciation will be wiped off with price depreciation. That's how bonds work. You've got to understand this. That is how bonds work. Price appreciation is not there for bonds. Bonds also, they do not compound their interest. And I think a lot of people miss out on this too when it comes to bond market. Compounding interest is simple. I take $1,000, I get 8% a year. All right. So in simple interest, I have $1,000, I have $1,080 the next year, I have $1,160 the next year. Because it's 8% is my interest payment, it's always going to be 8%. It's always going to be in simple interest. I'm always going to get $80 a year on the initial $1,000. I mean, literally, it doesn't matter how many years I have. Let's say I have 8% is my simple interest for 5 years. That means I'm going to have $400 because I have $80 each year on the 8% on the $1,000. It doesn't compound. That's called simple interest, and that's what bonds do. Because bonds, you don't reinvest to buy more shares of the bonds. Bonds pays you cash. Now, you can reinvest that in something else, but the bond you own is not compounding. It's simple interest. You know for a fact, I'm getting 5% on that $1,000 each and every year. I'm getting $50 each and every year, regardless if I have it for a year or 20 years. I'm getting $50 on my $1,000 investment. It's not compounding. That means I'm not getting, so in a compounding, how it works is $1,000 at 8% compounding. After 1 year, I get $80. But now I'm getting 8% not on that 1,000, but on that 1,080, which means the following year, I won't have $1,160. I'll have $1,166 because I'm making interest on my interest. So that's compounding. Simple interest, I'm just making interest on my principal. That's it. And my principal doesn't change because bonds, you do not reinvest the proceeds. It doesn't work like that. A bond is issued $1,000, like essentially one share. You're always going to have that one share. No more, no less. You'll always have that one, and you're always going to get that 5% yield. That's always what's going to happen. Nothing else changes. That's how the bond market works. So I hear people say, well, I think I can get 8% a year compounding. No, you can't. You cannot get 8% a year compounding. It doesn't work like that in the bond market. Now, again, you're having these mutual fund managers here at Vanguard who might be able to go into the market and take those interest payments that they're collecting, they're gathering them up, and they're saying, well, I'm going to go over there and buy that bond. I'm going to buy that bond. That's fine, but that's not compounding interest. Bonds do not compound in interest. You get 5% a year. End of story. Bonds do not appreciate, or they don't depreciate. They don't go either way in the course of the holding of that bond. Now, bond can depreciate to zero. That's your risk. And that's my concern with having high yield bonds, because at the end of the day, they have more risk than a typical bond fund without that much more return. A little bit more return, don't get me wrong, but the risk is similar to stocks, not quite there. Let's just say the risk is 65% of the risk of the stock market, risk being the ups and downs fluctuation. But we're not getting 65% of the return of the stock market. We're just not. And why is that? Because the stock market does compound, And stocks, because they can go kaput, it's literally to zero, there's more upside. And on top of that, stocks are based on the earnings growth of corporate America and the world, which means those earnings growth do compound. So a dollar for earning today might be $1.10 tomorrow, might be $1.21 the following day, might be $1.34 the following day. Earnings growth is compounding, where each year is built on the previous year. That's how compounding works. Bonds don't do that. And so what happens is each and every year, the value of the stock slowly increases relative, and that's called the delta. The change is changing more and more and more so relative to the return on the bonds. So a high yield bond gives you similar, not quite similar, but lower risk than stocks, with certainly much, much higher risk than regular investment grade bonds, or certainly government bonds. But they're giving you just a little bit more returns of investment grade bonds and regular bonds. So it's kind of like you're getting more risk, but not more return. And so this guy said, in my Roth IRA, I said, man, and I asked him, I said, well, what's the point? And I don't know what the point is. He doesn't have to answer me. But if the point is we want to get more bang for our buck, then the equity market is the way to go. You get more growth potentially in stocks than you do in bonds. You get more growth potentially in stocks than you do in high yield bonds. So if you're willing to take the risk of that down year right there, 27% or 21%, you might as well just go full throttle and take the risk in stocks, where you can get compounding growth and more growth potential than a bond. Because over time, the stocks has dwarfed, it's not even close. I mean, stock market has dwarfed the bond market by huge amounts of factors, without question. So if we're trying to get more bang for our buck relative to the risk we're taking, understanding the risk, stock market, there's no assurance. A bond, as long as a company doesn't go bankrupt, you start with 100,000, you end with 100,000. No getting around that. As long as it doesn't go bankrupt, you know for a fact that's what you're going to get for sure. That means there is less risk. Stock doesn't work like that. I mean, look at Tesla stock right now. It's going up and down, getting hammered. I mean, stocks do not work like that. Sears just went bankrupt. GE is down 60% from December 2016 to today. That's the risk of an individual stock, and that is similar to the risk of an individual high yield bond. But if you take stocks as a whole and you say, look, I got a basket of stocks, the risk doesn't get dwarfed, but it just is minimized to the point where the max, I don't know, you can never say a max loss, but historically in 2008, that was the worst we've seen since literally the Great Depression. So we have almost 100 years, and the worst we've ever had was 50%, which is bad. Don't get me wrong. But high yield bonds were down 40% during that same time, and they did not give you the same upside. It's just all there is to it. Now, lastly, with a high yield bond too, there is more risk to it going bankrupt. I mean, don't forget, these are bonds that are below investment grade credit quality. And a lot of times there's a reason why they're below investment grade credit quality, because they're not well capitalized. There's a lot of risk in terms of how their accounts receivable. They're not receiving their payments back in time, and so they got to chase out debt. They have too much debt to begin with. I mean, just a lot of junk bonds are high yield, because they have debt issues, cash flow issues, whatever. That's just the nature of it. Now, who is it? Ford used to have junk bonds, and people actually made pretty good money off that. Ford's unique. I mean, I'm not saying you don't buy it, but Ford's unique. I mean, the government had a very big reason to back Ford bonds back in 2008 and whatnot. I mean, because it's Ford, it's Americana. And so there are some instances where high yield bonds have proven profitable. I do not deny that, not in the least. But you're not buying Ford junk bonds. You're buying a high yield fund, which means you're going to have 500 constituents in your fund. Vanguard's fund has about 500 different bonds. One of them might be Ford, but it's such a minimal amount. The Ford making you money is going to be just a slither of what you could lose with all the risk that's inherent there. So again, I'm not telling you not to buy bonds. I like the idea of high yield bonds in a Roth IRA. That makes sense. We want anything that pays high yield in your Roth for sure, and high yields, dividends for sure, capital gains. At the end of the day, though, I just think if you're going to go for a little bit more bang for your buck and you're willing to take on risk, you might as well just go stocks. There's just no getting around that. There's just more bang for your buck compounding, where bonds don't do that. Anyway, hope this helps. If you like what you see here, by all means, comments help a lot. In fact, I'm doing this video because of the comment I received. So give me a comment down below. Thumbs up, my friends, helps a lot. Share the video if you like it. Of course, subscribe, and then go to the blog at heritagewealthplanning.com. See you guys next time. Thanks now.